Investing in stocks can be one of the most powerful ways to grow your wealth. But whether it's the right choice for you, that depends on your financial goals, your risk tolerance, and the time you're willing to commit. But here's something most people overlook. Mastering the stock market isn't just about what you know, it's about who you are. That's right. To be a truly successful stock investor, you need two things: technical skills, the kind you can learn from books, courses, and experience, and mindset, a specific set of personality traits that help you stay calm, patient, and rational when others panic. Most people can learn the technical part, but developing that mental fortitude, the emotional strength to handle uncertainty, fear, and greed, that's where only a few truly excel. Let's start with the first aspect, the technical side. This is the science of investing, and the good news is, it's completely learnable. When we talk about technical skills, we're really talking about two main areas. First, there's fundamental analysis. That's understanding the business behind the stock, reading balance sheets, income statements, and cash flow reports. It's about grasping key metrics like P/E ratios, profit margins, and revenue growth to figure out what a company is truly worth and whether it will have strong growth in the future. Then there's technical analysis. This focuses on market behavior, studying price patterns, trend lines, and indicators like moving averages or RSI to gauge market sentiment and possible price movements. Both these skill sets can be learned with dedication and practice. But here's the catch. Having these skills is like having a finely tuned race car. Without the right driver, the right temperament, it's hard to win the race. And that brings us to the second, often overlooked side of investing, the mindset. This is where things get tougher, because this is what separates average investors from truly successful ones. At its core, long-term investing requires a leap of faith. When you buy a stock, you're not just buying a ticker symbol. You're making a judgment call that the company will build great products, attract more customers in a healthy economy, use its capital wisely, and be led by management that shares the rewards of growth with shareholders like you. Now, for some industries, that leap of faith is even bigger. Think sunrise sectors like quick commerce or data centers. These are exciting spaces, but they're also unpredictable, often high on potential, low on proven profits. The growth can be exponential, but so can the risks. And this leap of faith brings us to the real challenge in investing, our own human nature. Because once you've taken that leap, it's your emotions that will try to shake your confidence and push you off track. So what really trips investors up? It's not lack of knowledge, it's psychology. Emotional biases are silent killers of portfolios. Let's uncover some of the hidden biases that quietly sabotage smart decisions and how to overcome them with awareness and discipline. First is the loss aversion. We feel the pain of a loss far more intensely than the joy of an equivalent gain. This makes us hold on to losing stocks, hoping they'll just break even, and sell winning stocks too early to lock in profits. The fix: create predefined sell triggers based on business fundamentals, not just price. If the thesis breaks, you sell, no matter the loss. Second is the herd mentality. The urge to follow the crowd, buying into bubbles because everyone else is. This is also called FOMO, the fear of missing out. Then there's panic selling during crashes. This is how you buy high and sell low. What's the fix? Develop independent thinking. Do your own research. Be skeptical of hype, as stocks are often overvalued when there is hype. These are the same stocks that fall harder when there is a downturn. True value is often found where others are fearful. Next is confirmation bias. This one's sneaky, and almost every investor falls for it at some point. We naturally love to look for information that supports what we already believe, and conveniently ignore anything that challenges it. So, if you own a particular stock, you'll probably find yourself reading only bullish articles, watching videos that praise the company, and following analysts who agree with your view. It feels good, because it confirms that you made the right choice. But here's the danger. When you surround yourself only with opinions that match your own, you stop seeing the risks. You stop asking, what could go wrong? And that's when bad decisions creep in. In this case, the fix is to actively seek out contrarian views. Look for smart people who disagree with you. Read the bearish reports. Listen to the critics. Ask yourself, what are the strongest arguments against my investment? If your thesis still stands strong after being challenged, you'll have far more conviction in your investment. And if it doesn't, you've just saved yourself from a costly mistake. Next one is overconfidence bias. This one often shows up after a few good wins. You pick a few stocks that do well, and suddenly you start to feel unstoppable. You think you've cracked the code. This feeling often peaks during a bull run, when almost everything you touch seems to go up. It's easy to mistake a rising market for your own investing intelligence. But remember, a bull run lifts everyone. It doesn't mean every decision was smart, it just means the tide is high. That's when overconfidence kicks in. You start taking bigger risks, ignoring your usual checks, maybe even doubling down on a single stock. The truth is, even the best investors in the world are wrong a lot of the time. The market has a way of humbling everyone eventually. The fix here is to stay humble and grounded, no matter how well you're doing. Remind yourself, a few wins don't make you invincible. Stick to your investment strategy and your risk limits. Keep your portfolio diversified, so one bad call doesn't undo all your progress. The fifth one is anchoring. Anchoring is when we get stuck on a past price, either the price we paid to buy the stock, or a stock sold high. We let that number drive our decisions instead of the company's current reality. I'll sell it when it reaches my buy price, I just want to recover my cost. Or, it has to go back to its previous high. That's anchoring talking. The problem is it turns investors into prisoners of a number, not students of the business. Why it's dangerous? Anchoring makes you ignore important changes, namely, new competitors, slowing sales, or deteriorating margins, because you're emotionally invested in getting back to that old price. It's a classic sunk cost trap. You hold on hoping to break even when the fundamentals no longer support the stock. Here's one way to overcome this. Use the start from scratch test. Imagine you have fresh cash today. Would you buy this stock at the current price? If the answer is no, ask yourself why you're still holding it. Couple that with these practical steps. Reevaluate the company's fundamentals, revenue trends, margins, competitive position, not its past chart. Set predefined rules for exits and position sizing so emotion doesn't make the call. Treat the original purchase price as a lesson, not a target. It's a sunk cost, not a decision rule. If you want a reference price, base it on valuation or future cash flow assumptions, not nostalgia for an old high. Anchoring fades when you build habits that force objective rechecks, and that's how you trade a fixed number for a flexible, smarter investing process. So, is investing right for you? It can be, if you can cultivate these essential traits. Patience. True wealth is built over years, not weeks. Can you let compounding do its quiet magic, without rushing the results? Discipline. Can you stick to your plan when fear and greed are both shouting for attention? Can you trust the process, without refreshing stock prices every hour? Humility. Can you admit when you're wrong, and learn from it, instead of defending a bad decision? The best investors aren't the ones who are always right. They're the ones who correct fast when they're wrong. Emotional resilience. Markets will fall, sometimes sharply. Can you stay calm, think rationally, and avoid panic when your portfolio dips 20 to 30%? Independent thinking. Can you stand apart from the crowd, buy when others are fearful, and stay cautious when others are euphoric? Investing isn't just a financial journey, it's a journey of self-mastery. The technical skills are your tools, but your mindset is your greatest asset. Take the time to not only learn the fundamentals and technicals, but also to understand and conquer your own biases. Because in the end, successful investing isn't just about numbers, it's about temperament. If you can master these traits, you'll not only survive the markets, you'll thrive in them. For many investors, a thoughtful mix of individual stocks and diversified funds offers the best balance between growth and stability, combining opportunity with peace of mind. If you found this helpful, like and subscribe for more insights into smart investing.